BYDFi is a crypto exchange on desktop and mobile where you can spot trade, futures trade, use leverage tokens, and copy the trades of top traders. If you sign up with the link in the description, you get a free $100 when you deposit $100. There's hundreds of crypto available on their spot exchange, as well as a free test account so you can practice futures trading without getting wrecked. BYDFi. Hello everybody, welcome back. So we're going to look at Forex and stocks and a little bit of Bitcoin towards the end, because this week we got CPI and FOMC, which is going to do something at some point. Crypto is definitely all still pointing down. Bitcoin still in its descending trend line. So we'll look at that last. But first of all, let's think about Forex and then to stocks, because with those two events coming in this week, that could be devastating, or it could be okay. At the moment, as far as I would say, as far as price action on Forex is concerned, so just thinking about the euro dollar, it's not too bad. We realistically were thinking that there is a good chance that we break down from here sooner rather than later, and I think we probably could still entertain that idea, at least maybe just another retest of it. Now, if we get like a poor CPI come through, and the Fed decide that they're going to raise rates again, which they could, because let me just put it to you now, with all the other central banks raising rates all the time, and projected that they're going to continue to raise rates until further notice, and the dollar's still relatively low, the effect on that is going to be a weak dollar, which for America is going to feed into inflation anyway. And so to think that they're going to pause just based on a decent CPI is only part of the picture. They may want to continue to raise rates regardless, even if it is just another 0.25. Because they don't want the dollar to get weaker and weaker and weaker. A weak dollar's okay for a short period of time, and it's not massively weak. It's kind of in a neutral area at the moment. But if, let's just say the ECB, Bank of England, Bank of Japan, and everybody else is going to continue to raise rates like they have projected, then the Fed might think, well, hang on a minute, what's that going to do to our dollar? It's not going to look particularly good if that's the direction it's going to go. So we'll see what CPI says, but if it's as expected or a little bit higher, I think it's on the cards that we're going to get another rate. They're going to raise rates again. I think they're just going to have to, and maybe they'll pause later, but I don't know. I just think it's kind of naive to expect them to pause at this point now, and I think markets are kind of expecting that they will go another 25 basis points. Yeah, that's just how it seems to me. Anyway, boring stuff, I know, but we've got to think about that because obviously they raise rates and everybody seems to think that they're not for some reason. It might add a little shock and a bit further downside to complement what could be this chart, which you could look at it in two ways. This could be a cup in handle ready to break out, or it could just be a bounce from a 200 simple moving exponential moving average and ready for another rejection. But it's not broken bearish, not massively bearish, but there is that short signal that was generated around here. So if we do move up, I think just generally hedging into some shorts would be okay, around the 50 exponential, around 108.1. We'll see where we go. Again, I'm not looking to probably not bother trade this chart, but we also see the 200 exponential around 108 as well, and that would just be another death cross retest. Interestingly, though, there is a pump signal on the 4-hourly, so conflicting signals, exactly what you'd expect to see really on a week of conflicting opinion on a fundamental perspective. So look, I would probably favour a rejection around here, and then at that point there, you can decide whether or not it's a position you'd want to hold through the CPI. Because if you take a position between 108 and 108.1, then look, if for whatever reason the CPI is amazing and the Fed pause, then that we see the euro rally up and the dollar go down. You get stopped out quite quickly. And also for those of us who hold stocks, commodities, and crypto, should benefit from that anyway. So this is like a hedge against your spot positions, if anything, with a tight stop loss, obviously. So that is how I would interpret the euro. Despite the pump signal on the 4-hourly, there is a short position to be taken around the 108 area. But again, extremely tight stop loss. Let's have a look at gold. So gold is actually looking okay here. It's not broken bullish. It's not done anything. It's kind of accumulating after the breakout of the descending triangle, which is only just coming off the back of the peak over there. So not a big problem. Momentum shifting towards the up here, so it's all actually looking pretty good here. And this is going to benefit from a weak dollar there, and it will be negatively impacted by a stronger dollar. So this also is waiting for the CPI. So yeah, it's a very correlated chart at the moment. So again, Forex still dominating the general direction of everything, but because it's been such a nonchalant few weeks, maybe month or more in Forex, it's not been the big bold moves that we saw earlier on, where we had this big demise from the dollar. Who told you that? I told you that. And so we've basically been fannying around sideways, really. So again, yeah, Dixie, technically, looking for a death cross retest of its own on the daily, but I'm not saying that is what's going to happen, but it is curling over. And if you were to look at this based on what we see right this very moment in time, you would actually expect a rejection from here. So I'm not sold. I mean, that is counter to what we've just talked about on the euro, really. The euro, looks like, it could do either. It's really difficult to interpret it, but it's only going to get rejected on the back of CPI and FOMC. And the euro does generally point up, despite the short signal on the daily. It generally does point up in the short term, but I still think it would be a place to layer into shorts, just like I say, as a hedge against the what the Fed are going to do. S&P breaking out from this level, so we expected a move up to this level. Now we've broken out of it so far on the daily. This is pre-market stuff, futures obviously, with no real problem so far. We've cancelled out the bearish divergence on this way up. It's all cancelled now, and we're looking to probably trend up a little higher. So if we have broken this level, which it looks like we have, we can go up to 4,003.4. That is an area marking this particular peak over here. But really, to be honest with you, stocks look really good, and I'm quite happy with my stock portfolio. My pension's looking really tasty as well. It's only really the crypto side of things, well, besides from Bitcoin, which is obviously still significantly up from the entry points. It's only really the altcoin problem, which is sort of, I suppose, like giving me a bit of a headache. It's not an overall problem in the economy or the financial world or system. Everything's looking still quite good. So with that said, obviously altcoins are an extremely risky place to be. And my main fear would be that we do find a peak on the S&P soon, and the dollar does actually bounce and have a little rally, and for an extended period of time, whether it's weeks or months, and causes a natural consolidation in all markets. And it's at that point where you'd say, well, that is where we're going to get absolute wrecked city for altcoins. You think it's wrecked city now, it could easily get worse. Now, it's not the same for all altcoins. Obviously, we still bow to the epic chart of XRP, which again is looking not as great as it has in the past. But it's still okay. Its Bitcoin pair is still actually really good, to be honest with you, with the golden cross coming in. Again, I can make videos on XRP all day because there's a lot of evidence to suggest it's going to go up, and I know that doesn't go down well for a lot of people, but it is. It is a good chart. So let's just finish off with Bitcoin. And Bitcoin's relatively simple. Still a descending channel, which is a bullish formation once it's broken out. Looks like to me we probably want to at least retest the 200 exponential, which is around 25,375 again. There's nothing on this chart to be in any way sort of massively bullish or anything like that. They've not really made any new lows, despite these wicks all being respected on the 200s exponential. So no bullish divergence can really be pointed out there. Turning up with momentum. I mean, the 4 hourly does have bullish divergence, despite it being more or less a flat level. It's not anything that I would hold too close to my chest as a very special card. It's not the greatest hand I've ever been dealt, to be honest with you. And I would focus mostly on the formation, which is one of a downtrend within a channel. And if the channel's respected, excellent. And the channel should break to the up at some point down the line. And like I said, we've projected time frame on this, which could lead us towards the end of the month, where your 200 simple moving average on your daily crosses into this, adding very strong, rigorous support of the channel, maybe that would be a place to take a position within the channel. It would be the next place that I decide to buy some Bitcoin, to be honest with you. Obviously, I bought quite enough of this down at the 21,000s. I don't really want to buy any more unless we have a deeper drop. And at the moment, the deeper drop would be towards 23,600. But by the end of the month, it's going to be about $1,000 above that. So that is basically the deal. Early days at the moment. It's going to be a rocky road with these two events take place this week. And so we should sit back and watch the show, and the show mostly dominated by Forex, which will have a ripple effect across all markets. And so at the moment, things actually look okay, but let's not be too naive. The FOMC meeting could say we're going to continue to raise rates, and if I were them, if I was in their shoes, I would probably do that just to try to avoid the Dixie breaking down much further. Because again, weak dollar is inflation for America. You know, stronger dollar is not. So you don't want to destroy the dollar, despite we all wanting it to go down. If you see the dollar break down significantly, it's a problem for inflation, and this is what's going on at the moment. Central bank wars, really. The central bank wars. This has been the problem the whole time. I don't understand why the Bank of England, Bank of Japan, Bank of the ECB, basically, I don't know why they were so slow to raise rates. If there was a coordinated effort to raise rates together, then currency pairs wouldn't have been so dramatically affected. But obviously, that's not how things work. You've got to, central banks have to do things which are appropriate to the countries of which they operate within. And so now you've got this discrepancy of who's going to raise rates faster and harder and for longer, and that is going to have some big swings in currency pairs. Right, I'll leave it with you there, but thank you for watching. Hope you have a nice day. Take it easy.